Hello, we are Islanders Elite, industry number 3, team letter A. I'm Jacob McCall. I manage the celebrity endorsements as well as the private label initiatives.
Hi, my name is Belinda Goldwater, and I managed the internet and wholesale marketing segments.
Hi, I'm Daniela Penaloza, and I manage production facilities and distribution and warehouse.
Hi, my name is Katherin Sevilla, and I manage compensation and training as well as branded production.
Hello, my name is Nassib Zeidan. I manage the corporate citizenship, finance, and cash flows in the Islander Elite industry, team industry 3, team A.
The strategic vision for AIslander is comprised of innovation of a company that infused high brand visibility with continued growth, resulting in trust and loyal bond against our global team of employees, wholesalers, and most importantly, our customers. We are client-focused rather than sales-focused, with a wide variety of high quality and style-enhanced models that differentiate us from rivals. We strive to create a seamless experience for our customers through a user-friendly website and staff who are supportive and approachable. We aspire to walk side by side with the communities we serve.
Our initial competitive strategy in North America was to employ a global differentiation strategy. The goal was to set out our brand apart from the competition and gain market share by offering a complete high quality and top-notch service experience via a higher model availability, retailer support, SQ rating, and advertising, with a large network of retailers offering our brand. With this strategy in mind, we spent almost $78,000 in total in the 4 markets and were able to gain 3,400 retailer outlets with a starting brand reputation of 70, and our best market share pickups being in the North American wholesale and private label sectors this year.
We wanted to be above industry average SQ rating. Thus, we targeted an SQ rating of 6.5, anticipating the industry wouldn't go above the previous year's 4.0 SQ rating average. While we had a higher SQ rating than D company, they beat us in few areas within marketing, as mentioned earlier. We also increased our model availability count to 350, as did company D. To stay competitive, assuming companies would also increase theirs by only 50 to 100 from the previous year's average of 200. Additionally, we also started off heavily investing in Six Sigma quality programs to accumulate the benefits of higher SQ ratings and reducing reject rates, which help lower reject pair costs and support our strategy of being a high quality retailer. In an effort to target above average SQ ratings, investments in higher superior material and slight increases in enhanced styling features were made.
Our production's goal was to be able to support demand as it was expected to grow after year 11. Therefore, it was decided to expand in Latin America, especially since tariff costs were higher to ship to that facility.
After analyzing the results from year 11, we realized that the market was going to be highly competitive and that there were several competitors that were utilizing the same strategy as we were. Team D was proving to be our biggest competitor at the time and was carrying the same vision as our company. Their products were the highest priced, with above average model availability and SQ rating at that time. They were able to take first place, where we took second because they offered free shipping, higher rebates, search engine advertising, and shorter delivery times from the start. It was obvious that we needed to step up our efforts in several areas in order to be effectively competitive and gain market share. So in year 12, we made some course corrections in strategy by adding in budget for search engine advertising where we previously had none, increasing our rebate offers, as well as our retail and wholesale prices to be more in line with our long-term strategic vision.
Initially, we participated and aggressively attacked the private label industry. And in the first year, we sold all available pairs. And we provided the second highest SQ rating and averaged around 16% of the private label markets.
By the end of year 17, we had held true to our strategic vision to be a high-end leader in the market. We ended with the highest SQ rating in the market at 10, higher model availability at 500 models, and unsurpassed marketing efforts totaling roughly $460,000, including support for our retailers. Competition ramped up to an all-time high in year 17 with larger than average increases in marketing dollars and model availability. We underestimated how aggressive other companies would be in regard to celebrity offers and lost several of our crucial celebrity endorsements in year 16, which contributed to an unexpected dip in market share this fiscal year. Despite this hit, we were still able to command the highest wholesale market share in 3 out of 4 markets. Enhanced Footwear, with their price leader strategy, was able to dominate the market the last 4 years of the competition, even with an extremely low model count. They overcame this deficit with a lower than average price point and SQ rating, in addition to strong marketing budget backed by celebrity appeal.
Over the years, we wanted to gradually increase our SQ rating in order to be at a 10 SQ rating by year 17. Having a higher SQ rating and module count helped increase demand within our products, which was needed as we no longer had sufficient celebrity support. This effort also helped us stay competitive against our competitors that decided to increase their model count to 400 to 500 for year 16 and 17. In addition, within the last few years, we started investing more in enhanced styling features instead of superior material to increase SQ ratings, as we found there was better cost-saving benefits as superior material expenses continue to rise. With years of Six Sigma benefit accumulated, we were also able to lower costs within SQ ratings cost per pair while continuing to increase SQ ratings. These efforts helped us have below average industry cost of SQ ratings while simultaneously having one of the highest SQ ratings within the industry.
Our production was able to support the demand for the wholesale segment, just as planned in year 11. However, demand growth lower in year 17. Thus, considering growth in demand did not meet expectations, which resulted in the company having too much space, it was decided that in order to save on costs within our it was best to sell part of the equipment and gain back some cash. Hence, 1,000 pairs were sold in North America and 500 pairs were sold in Asia. Keeping in mind that this was our last year to make decisions, if we would have continued into year 18, then equipment would have not been sold.
The private market, by year 17, we were no longer competing in the private label industry because we utilized all of our available resources in order to keep up with the demand in the internet and the wholesale markets.
Moving to the net sales revenue, which is by definition represent the dollars received from both branded and the private label footwear sales after exchange rate adjustment. It's clearly observed that we have the highest. It's clearly observed that we had the highest revenue within our industry 3, with exception of year 12, where company G bites us and we came in the 2nd place. Due to our high revenue, it allowed us to be more flexible with our investments in order to support future gains and stay consistent with our differential strategy.
In order to maximize revenue, it was important to distribute product based on demand trends per region and ensure each region had a healthy surplus to take advantage of additional sales.
To help continue boost revenue, as the branded production manager, I would partner with the production facility manager to discuss expansions and investments in productivity opportunities, especially after noticing our competitors also investing in expansions and productivity improvements.
Another factor we need to look at is the earning per share, which is by definition is the net income divided by the number of shares issued by the stakeholders. Highest EPS indicates that the company earnings more income per share stock outstanding. If we look at the trends from year 11 to year 17, we have done a good job and have a good earning per share as per the investor estimation. In comparison with our competitor, we was in the top 3 places from year 11 to year 17. Where only year 17 we have a drop due to the highest interest expenses and the highest liability that affects our EPS ratio.
In year 10, Asia had rejected a reject rate of 10%, and after buying new equipment in year 11, the reject rate reduced to 3.2% in branded production, therefore helping reduce our reject costs more than half. Option D was implemented in year 13 and reflected in year 14 in North America. The production improvement option helped increase worker productivity by 50%, reduce labor costs by 75% from years 13 to 14, and continue to produce annual cost savings throughout the years. Option B was applied for all 4 facilities, which helped lay out revisions to reduce production run setup costs by 50%.
In order to help lower material costs at production facilities, we heavily started off investing in best practice trainings, which also helped increase productivity levels. We wanted to start heavily investing in best practice trainings to accumulate the most cost-saving benefits from it, and lowering the spending as benefits diminished, and the years went on to try to find an optimal spending level. Further, as our demand increased over the years, we wanted to use as much of our production capacity as possible to lower branded production costs by spreading the fixed costs across production. Lastly, both investments in best practices and Six Sigma programs also help reduce reject rates and cost.
Another important factor we need to look at is the stock price, which is a function of the revenue growth, earning per share, ROE, credit ratings, and dividend per share growth. Our stock price is increased by increasing EPS. If we look at the trend from year 11 to year 17, we can observe that the trend of our company was constantly in the top 3 from year 11 to year 16. However, in year 17, our stock price landed in the 6th place. Actually, there are many factors that influence our stock price. We will mention some of these factors that could influence our stock price to decrease. The demand growth was one of the major factors that make the stock price to be down, decreasing in the earning per share, since it was decreased from year 16, and in comparison with our 3-year strategy plan. Our differential strategy for our company to maintain a health ending cash after year 16. Therefore, having to take on money loans that affect this strategy. In year 15, our co-managers decided to issue stocks, and it caused a share dilution, which means that the value of the existing share for investor reduced. Hence, that a decrease in the stock price has been happened.
D Company was our closest strategic competitor from inside the industry. Both AIslander Elite and D started off with a differentiation strategy in place, with higher than average pricing in both internet and wholesale pricing, model count, SQ rating, and marketing budgets. Both companies were able to accelerate to lead the industry starting in year 11, but when D Company faltered more through to year 17 to stay on top, our company was more consistently held a spot within the top 3 of all companies, all the way until year 17, where we landed in 5th place.
To continue to highlight our similarities, as seen in the bar graph, our model availability strategy were very similar to Company D, as we both grew our model counts over the years. We both started and ended with the same model count. Within an SQ rating standpoint, this is where we differed from D Company as the years went on. D Company began lowering their SQ rating strategy starting in year 14, while we had a steady growth in SQ ratings over the years, which helped us gain greater success in earnings as demand continued to increase.
While we had a very similar wholesale pricing strategy to company 3 throughout, we were able to increase our wholesale market share every year, but the final year, 17, where we had a very slight dip. On the other hand, company D's market share stayed below average every year, oftentimes decreasing. This was due to our effective strategy implementation of having higher increasing SQ ratings, brand reputation, and celebrity endorsements that increase the effectiveness of our marketing budget.
Our competitive analysis based on 3 factors: strategy, operations, and financial results. AIslander elite operations on all regions, North America, Europe, Africa, Asia Pacific, Latin America. But again, we will focus on the North America, and here a clear example how the operation were working. We will compare and analyze what's happened between year 11 to year 17. Our company focused on the wholesale and internet brand advertising in all regions, while company D did not take the risk, which was beneficial to them and gained a greater earnings, return on equity, stock price, and credit rating. Especially this appears clearly in year 17.
As you can see, we had almost identical market budget to company D. We were able to utilize our budgets more effectively through proper utilization of celebrity endorsements to gain higher market share than our competitors. We opted to take a hiatus from the private label market, and company D seized this opportunity to take gains in this market sector. Despite attempts to re-enter this segment in year 14, we were not able to successfully gain the momentum we lost in this area.
Also, in addition to what my co-manager said, we find another way to feed the market with brand advertising to inject more investment in this category. If we can see from this comparison between our company and company D, we have 2 different periods. Period 11 to 14 and period 15 to 17. It's clearly shown that we have near brand advertising figures, while we have highest market share in the internet and wholesale market in comparison to the private market, which company D was concentrating on. This gives an advantage to have highest market share in those 2 periods.
AIslanders in general had higher and consistently increasing market shares in the wholesale and internet sectors as we focused on greater search engine and brand marketing backed by popular celebrity endorsements. Company D had a more stagnant, generally averaging around 10% or lower market share in these sectors, as they did not take any risks and invest in the higher SQ ratings and advertising dollars. For the private label sales, company D had a greater share among the years and was mostly consistent in this market more than our company was.
In year 13, production could not support the private label. It was decided to give all production towards internet and wholesale markets because those sectors were more profitable. In year 14, we attempted to revisit private label and attribute some pairs to the market. Unfortunately, we were unsuccessful due to our offer prices compared to other companies.
Our company had a considerable amount of liabilities due to all the expansion costs and having to repurchase all new equipment on year 15 for North America facility and 16 for the Asia Pacific facility. It was decided to purchase all new equipment instead of refurbished due to being able to keep rejection costs down.
In addition to that, we have high liability in comparison with the company D due to the long-term loans that we have taken to inject our business in order to boost the market, especially the loans that we have taken in year 15 and 16. This affects our growth profit in year 17. One important factor that affect our strategy is the profit margin. The profit margin here clearly shows that we have a lower profit margin than company D due to our investment in the product optimization, interest expenses due to the high loans that we have taken in the recent periods, and the brand advertising to boost our business in the market share industry.
As shown on the graphs, D company increased its capacity slightly under AIslander on year 12. However, in year 14, AIslanders expanded in all 4 regions, and D company continued to focus its production in North America, Asia Pacific, and Latin America. In year 17, you can notice how D company did not take advantage of expanding in Europe, and also did not increase capacity in any of its current regions. Meanwhile, AIslanders took advantage of expanding and having all regions support themselves, which resulted in lower shipping costs and tariffs.
We acknowledge the impact of signing celebrities with high appeal indexes. It's important to increase and maintain our celebrity appeal moving forward.
In earlier years, production expansion was a result of how demand acted in previous years. Unfortunately, that resulted in some years falling short in meeting demand. Therefore, it was concluded to take a closer look at demand and expand in a more efficient way by forecasting demand's growth and expanding accordingly. This same method would have been applied in the upcoming years.
Using the lessons we learned from our team decision to saturate all 4 markets with heavier than normal marketing budgets in years 16 and 17, moving forward, we will better forecast competitively efficient budgeting amounts. This will allow us to regain market share and profitability lost in the last 2 years. It will also lessen the need for us to take out loans for this need that have contributed to higher than needed liabilities.
Considering by year 17, we had developed the highest SQ rating of 10 within the industry and had one of the biggest model availability, we would continue to sustain the current SQ rating and model availability to support our company's strategy. To stay on top of trends and stand out from our competitors, we would continue to slightly increase our investments on enhanced styling features within the next 3 years.
Moving to the finance strategy, the main objective of the finance strategy is to assist the finance of our company needs through finding suitable sources and for raising them. Based on the trends and the analysis that we have done in the previous slides, we will take the following decisions. First, increase profit margins through control our expenses and observe our loans, and have a growth strategy, increase the growth rate. Second, improve expenditures management by applying analysis to the competitor values and have a clear vision of the strategy. Third, cost saving strategy through implementation. For example, invest in technology solutions, reduce material expenses, and last, continue stock repurchase through market reinvesting.
Our future strategy for private label is to, again, continue to not participate in the private label industry. The reasons behind that is the resources needed to meet the demand in the other markets. We didn't see it profitable enough to participate in the private label, as in the profit margins were too low. And then again, our failed attempt in year 14 to re-enter the market kind of solidified our decision to not participate in the private label industry.
Finally, we will brief what's the lessons learned from this exercise or this game. First, we should margin focused approach. We should have a clear vision an effective plan to control our profit margin strategy, constant monitoring of the prices, focus on business operations, and differentiate our business strategy. Okay, second, improve the credit rating. Always, we should have a clear, close attention to the following 3 parameters: debit to asset ratio, interest coverage ratio, and default risk ratio among different periods.
One of the most valuable takeaways is the importance of time spent up front tracking and analyzing data and trends from the previous year's activities in the industry and with each individual company. The more accurate this forecasting, the tighter and more competitive budgets that we can set for future marketing for future years. It's more cost efficient to be an effective marketing leader, but not to be to the point of excess that creates needs for loans to be taken out to pay for these expenditures.
As mentioned earlier, analyzing demand for production growth was something that should have been considered from the beginning. However, it was challenging to do so in the earlier years because there was not enough database to base our decisions on. After some trial and error on year 15, it was easier to forecast demand if the operation managers would have had started analyzing earlier. Production would have grown in a smoother slope and not as harshly as it did in some years. Demand had always been met and profits would have always been maximized. Cost-saving approach that should have been implemented was to invest in production improvements, option Ds, and for all the facilities instead of expanding, because it would have helped with labor costs, production costs, and increased productivity, which as a result would have also helped lower material costs.
Additional cost-saving approaches could have been initiated by finding further optimal balance in costs within production. As the pure material became more expensive, we found it was cheaper to increase enhanced styling features in an effort to increase our SQ ratings. As a result, we continue to have below average cost per SQ ratings per star compared to the industry.
In year 17, we had a much lower celebrity appeal score than we have preferred and has experienced in the previous years. We've learned from that impact how important it is to land the contracts with the celebrities with high appeal scores and maintaining that celebrity appeal impact. Our last lesson learned was with the private label, how it is very price sensitive, and just with the operating strategy we were utilizing, it was difficult for us to remain competitive within that market.
And that sums up our summary of our strategy for AIslanders Elite. We appreciate your time. Thank you.